Hello, I'm John Neyland with JCN Financial. Over the last 18 years, I've had a specialty, tax-efficient distribution planning. Over those 18 years, I've learned something. Owners of large IRAs, that'd be an IRA of $1 million or more, many of them are paying much more than they have to pay in taxation. Well, why is that? Were they willing to do that? No, it's not on purpose. They just don't know any better. They don't understand the rules. They don't understand that an IRA is taxed 6 different ways. Think about that. At age 72, you've got to take out what's called an RMD, Required Minimum Distribution. This amount will increase by percentage every year as you go forward with an ever-increasing balance. When you take this RMD out, it's taxed that year. That's the first tax. Now, the second thing that happens is when extra income comes onto your return, it elevates all of the taxes on all of the money earned that year. The third tax occurs when you save the money. It sits in a savings account and is taxed in. The fourth, it contributes to tax on your Medicare, contributes to tax on Social Security, and the last one, catch this, an IRD tax, income in respect to the decedent. If you do what you've always done, you're going to pay more than you have to pay. The idea is you want to find some way of reducing the amount of this RMD or eliminate it altogether. If you do that, you'll have a lot less in taxation. Again, on $1 million IRA or more, we're talking of hundreds of thousands of dollars potentially over your lifetime. Now, the trouble with this is that the rules are pretty simple, but it's a complex process to get down to really how much to do, when do you do it, what are all the ramifications. That's where I come in. I can help you. I can help you understand what your RMD is going to be, the taxation on the IRA, and what your options are to minimize it. Let's take a look at a pretty straightforward example of a common case where you can get a better idea of exactly what you can do and how it may help you. Let's take a peek. Okay, today we're going to try to take a very simplified look at a rather complex situation. Nothing simple about this, but that doesn't mean it's not worthwhile to do or to understand. Understand with your IRA, because of the way they're set up, you're not going to have a problem until it's too late to fix it for most people. The reason being is typically you recognize you have a problem at the age of your RMD. IRAs are forced to take out a required minimum distribution. They used to start at 70.5, now they start at 72. And what will end up happening is not only must you take it out that year, it's one of the biggest, if not the biggest penalty on the books for missing it. So if you have to take out, say, a $50,000 RMD and you miss it by one day, the minimum penalty is $25,000. So you got to get it out. And most retirees are very well aware of this. CPAs are well aware of this. And they spend all their focus, really think about it, paying the government. Make sure we pay the government in time so I'm not penalized any further. And this chart here shows you how it works. At 72, you divide your balance by 25.6. That calculates your RMD. Take a look at it at 82. Is 17.1. As the divisor gets smaller, the amount that comes out is larger. Now what happens is you've got to take it out whether you want to or not. And that's what compounds all your taxation. So let's take a look at a plan we do here. Pretty sophisticated, but I'm going to try to make it really simple. Contact me for more information, for help, or if you don't understand, then I'll be glad to help you on a one-on-one call. Let's take our software here. Take a look at the basics. This is a typical client of ours. They have 2 types of money. They have retirement money and non-retirement money. When I do this plan to determine your IRA analysis, I'm gonna do a full-fledged plan. I'm gonna start off by asking you how much money you'd like to have to live on, and you're gonna give me a number. I'm gonna put that into the computer program. I'm gonna include your expected cash flow. That may be Social Security, it may be pension, whatever that is, maybe rental income. On your IRAs, I'm gonna put your IRAs down as a growth account and a fixed income account. And when it's all said and done, we're gonna take a look at a snapshot of where you are. This particular client has $400,000 in non-retirement money and $1.7 million in retirement money. The total investments are $2.1 million. So, and they're 58 years of age. So the key bit of analysis I'll use, the one thing I'll know when you contact me and I do this analysis for you, I will know, you will know if I can help you, if the plan shows excess cash flow due to RMD. Here's an example of this case here. You see they wanted to retire at 65 and wanted $114,869 for income. For that income that year, they take out $68,921 in Social Security benefits, and then take out another $45,948 out of their non-retirement account, leaving them with a sum total taken out of $114,869, exactly as they wanted. So there's no issue here. And so this couple's typical of, I would imagine, most retirees. You quit working, you find things you want to do, you do less of what you don't want to do, and all of a sudden at 72, your CPA starts talking to you about your RMD. And now some tension comes into play because you're going to find that you more than likely have to take out a wallop in more than you expect, and you don't want or need to take it out. But guess what? You're going to be highly focused in getting out, and you're not going to be late. You know why? One of the biggest penalties, if not the biggest penalty on the books, is for taking that RMD out late. It's a 50% penalty. So if your RMD is $50,000, your penalty is a minimum of $25,000. So I find most people that come to me, that's their biggest concern, is avoiding these penalties. And really and truly, you're going to see here in a minute, there's something more important than that. Take a look at this client here, and you'll see that at age 72, when their RMD starts, they want $131,948. They have $79,000 coming in from Social Security, but look at the amount of the RMD. The previous year they took out 51. This year they took out 125 after tax because they had to. They paid tax on all that money. $73,000 was left over of excess cash flow after they paid the tax. And that cash flow now goes to where? An investment account or savings account. What happens there? Think about it. You put $73,000 in a savings account and it makes $1. What happens? It's taxed yet again. So you take a look at this. This particular client, over their retirement, had $3,290,353 of excess cash flow. Well, let me ask you this question. These years where all this extra cash flow was going into the return, what did that do to their effective tax bracket? Exactly. We were marginal tax rates, aren't we? So now they pay more taxes on all their dollars all along. Well, let's take a little closer look at this and take a look at the retirement account. And we're going to see a couple things here. Notice that the growth account is worth $1 million at 58. And now they take the RMD out of $122,399. They pay $30,600 in taxes that year on it. It's a pretty tough bite. But look what happens. As time goes, because their balance grows, the divisor becomes smaller, they're taking more and more out. By age 84, the RMD is $294,485. Can you imagine? It's too late now. And you pay $73,621 in taxes that year. And by age 90, they take out $103 that year and pay $103 in taxes. The total tax they paid over that time frame was $1,191,969. But that's not all the tax. Remember, this is one of the accounts. The other account is their fixed income account, which is going to be a bonds or cash, and they're going to pay $333,982 on that one. Now, those are their living taxes. But what happens to the disposition of your IRA when you die? The government gets paid again, the IRD tax. In this case, the IRD tax is right here, $1,167,047. So they're paying 2.8. They're paying about $3 million in taxes on that IRA over their lifetime. Take a look at their income. They take out $3,867,000 in income, and they pay $3 million in taxes. So what could they do? We want to minimize or eliminate this RMD. Very, very simple proposition here, which is going to be to use a Roth conversion, convert from an IRA to a Roth IRA. Now, I'm going to share with you some of the most common miscues I see with this is. I have many people come in here and say, John, I want to convert to my Roth IRA. I want to convert to a certain bracket. And I'll always ask you, well, Jim, why do you want to convert to that bracket right there? He goes, well, I want to minimize my taxes. And I said, well, how is that minimizing your taxes? Well, if I convert at a 25% bracket, I pay less taxes than a 33% bracket. And my question to you is going to be, is that so? You may be on the conversion that's so, but there's a bigger picture to take a look at here. And so some people say, well, John, I want to wait until I'm retired, because when I'm retired, I'll be in a lower tax bracket. And that does make sense. These mistakes, they happen in part because they're common sense, right? I convert to a certain bracket, that makes sense. I'll wait till I'm in a lower tax bracket, that makes sense. Until maybe you do the math on it. So this particular client, I'm going to suggest to them, I would convert starting at age 65, I'm going to start at 58, your age now. I want to compare that. So I go to this case here, and we're going to convert $200,000 for 5 years, or $1 million of that IRA over a 5-year period, and pay $60,000 in tax a year, or $300,000 in taxes. Now, granted, they're paying a higher tax rate to do this now because they're working and they have income. But understand this also. You know, a dollar will double every 10 years if you make 7.2%. So you have an IRA account balance right here. In 10 years' time, the growth will double. Guess what else will double? Guess what else compounds? Your taxes. If you have a $300,000 tax on your IRA and it grows over 10 years' time, the account expands over 10 years' time, your tax doubles as well. So in this case, we did this conversion. Now we want to go back and see, how does this affect excess cash flow? And looking over here, you'll notice there's no red column for excess cash flow. We've absolutely eliminated their excess cash flow for every year. That means every year we have a lower tax bracket. They're paying less taxes every year, less tax in the end. So then another consideration is going to be, what if I wait until I'm 65, I'll be in a lower tax bracket. That may or may not be better. Let's just take a look at it and see. So at 65, they're still going to be taking income out. They're going to be retired, but they're going to be living, so they're going to be paying taxes. And their income at 65 will be $164,000 a year. We go over here to the Roth, and we convert it at a later time. But I want you to see what happens here. It was $1 million at 58, right? Well, they waited to 65, so it grew by $770,000. At a 30% tax rate, that's roughly about what, a $320,000 tax. It grew as well. But they do pay less tax to convert because they're in retirement, they're not drawing as much money. So instead of paying $300,000 a year for that, they're going to pay $250,000. So they pay less taxes. And in this case here, they don't eliminate their excess cash flow. Didn't happen. Didn't happen. So they waited that period of time to save tax on conversion, which they did, but the IRAs grew in value. The R&Ds are still there, and we'll do a comparison now 3 ways. We'll show not doing anything as the current. We're going to show the Roth at 65, and we're going to show at 58 at the current age. So this is net after tax, what's left over after taxes are paid. The first light green here is doing nothing, and they would have a lot of money at their death, $11,494,000 left over. If they do a Roth, if they wait until 65, and by the way, they pay less to convert it, they have about $1.3 million more, or $12,803,000. But if they did the Roth at 58, they've got the most amount of money, $1,418,104. That's roughly almost $3 million more, about $2.7 million more. Stop and think about what we just said here. That is $2.7 million more with no better investment. Are you concerned about your investments? Do you worry about the volatility of the market? I think everybody does to some degree. But if you do, or even if you don't, wouldn't it make sense first just to keep more of a part of yours? I encourage you to contact me on the link shown below. I'm glad to help you. There's no cost for this consultation. My staff will reach out to you. We'll get the information put together. I'll do your analysis, and in a few weeks' time, I'll be able to share that with you. Enjoyed visiting with you. Give me a call for any reason. Love taking your call. John Neyland.